Picture this. It's a sweltering Tuesday in early July.
Right, just brutally hot.
Exactly. Across 13 states, air conditioners are just running at maximum capacity. Industrial plants are humming along, and, quietly in these massive server farms scattered all across the region, millions of microprocessors are training AI models.
Drawing just massive continuous streams of electricity.
Right, and on the regional power grid, demand suddenly surges to a record-breaking 168 gigawatts.
Which is an enormous number.
It is. The system is pushed so close to the edge of, basically total collapse, that the wholesale price of electricity, like the raw cost of keeping society functioning, it violently spikes.
Oh yeah, from an average of $80 per megawatt hour to a staggering $800.
A 1,000% increase, virtually overnight.
Yeah.
And the most terrifying part of this whole scenario, the market operators who actually manage this grid, they ran an auction to secure future power reserves, and they came up short.
Dramatically short.
Right, by an amount equal to 7 full-scale nuclear reactors. The energy just isn't there.
No, it's not. I mean, it is a profound structural deficit.
Yeah.
We are sitting here in early August of 2026, and the American energy grid is facing this collision of physical stress and surging demand. And it's fundamentally breaking the historical models. The margin for error has just completely evaporated.
Which brings us to the core mission of our deep dive today. So, welcome everyone. We are taking that signature talk tickers approach today.
Data forward, zero fluff.
Exactly. Plain language and entirely focused on actionable intelligence for you, the retail investor. Today, we are breaking down the Q2 2026 earnings call of Exelon Corporation.
Ticker symbol EXE.
Yep, the massive utility giant EXE. We are taking the corporate transcript, the management commentary, the raw financials, and the actual underlying physics of the grid to determine whether this stock is a buy, a hold, or a sell for your portfolio.
Because we have to move past the glossy corporate summaries, right?
Always. We need to look at the actual math. So, okay, let's unpack this. Let's start with the baseline. What were the actual reported headline numbers that Exelon delivered to Wall Street for the second quarter?
Okay, so the primary figure you want to anchor on is their adjusted operating earnings. That came in at 43 cents per share for the quarter. 43
cents, okay.
Yeah, and that number is highly significant for two reasons. First, it perfectly met the consensus expectations of the market.
So no big surprises.
Right, exactly. There was no miss, and there was no massive unpredicted beat, just right on target. And second, it represents a 4-cent per share increase compared to the exact same quarter last year.
Which was Q2 of 2025.
Correct, where they reported 39 cents per share. And alongside that quarterly print, management utilized the call to officially reaffirm their full year 2026 earnings guidance.
Which is always a good sign for stability.
Definitely. They're keeping it locked in that previously stated range of $2.81 to $2.91 per share.
Okay, with an explicit commitment to hitting the midpoint of that range.
Yeah, exactly. The midpoint or better. That's what they committed to.
Okay, I want to dissect that 4-cent year-over-year jump for a second. Because if you are an investor who's used to, the hyper-growth tech sector, a 4-cent increase on a 39-cent base might sound, negligible.
Like a rounding error. Yeah.
Right. But when you are dealing with a heavily regulated utility, every single penny is fought over in regulatory hearings. It's heavily scrutinized. I mean, it's basically a battleground.
It absolutely is.
So how do we logically build the bridge from the 39 cents last year to the 43 cents this year? Like, where did the capital actually flow?
Well, to understand a utility stock, you really have to look at the cross currents, right? The exact tailwinds and headwinds.
Okay.
So the math behind that 4-cent climb breaks down into a gross gain of 9 cents, which was then offset by gross loss of 5 cents.
9 up, 5 down. Got it. Let's look at the positive side of the ledger first.
Sure. So Exelon captured a 4-cent per share benefit stemming directly from new distribution and transmission rates. But it is super vital to note that this specific 4-cent gain is net of depreciation and a metric called AFUDC.
Okay, wait, let's pause right there. Because AFUDC is one of those classic Wall Street acronyms that companies love to use just to glaze over the eyes of retail investors.
Oh, for sure. It's total jargon.
What is the actual mechanism here? And why does a utility investor even need to care about it?
Okay, so it stands for Allowance for Funds Used During Construction.
Catchy.
Very. But to understand why it actually matters, you have to understand the fundamental business model of a regulated utility. Utilities are legally granted a monopoly over a specific geographic area.
Right. No one else can run power lines in their territory.
Exactly. And in exchange for that monopoly, their profits are strictly capped by state regulators. The way they actually grow their profits is by growing what's called their rate base.
Which is their physical assets.
Yeah, the total value of all the physical assets. The poles, the wires, the transformers, basically everything they've built and are actively using to serve customers.
Okay.
Regulators allow them to earn a set percentage return on that rate base, usually somewhere around 9 or 10%.
So if they build $1 billion transmission line, they get to charge ratepayers enough to cover the cost of a line, plus a guaranteed, say, 10% profit margin on that $1 billion.
Precisely. But here's the catch. A massive transmission project or a new substation, that might take 4 years to build.
Right, you don't just put that up overnight.
No, you don't. And during those 4 years, the utility is borrowing billions of dollars to pay construction crews, buy steel, all of that. So they're incurring massive interest expenses.
Oh, I see.
But regulators are incredibly strict about one rule. A utility cannot charge ratepayers for an asset until it is fully completed and quote-unquote used and useful.
Oh, wow. So they're just bleeding cash for 4 years.
Exactly. So how does the utility survive that cash drain during construction without going bankrupt? That is where AFUDC comes in.
Okay, so how does it work?
It's an accounting mechanism. It basically allows the utility to capitalize those financing costs. They create a non-cash earnings entry on their income statement today, and then they roll all those accumulated costs into the final price tag of the physical asset.
Which gets added to the rate base later when it's finally turned on.
You got it.
Okay, so it is essentially a bridge loan to themselves, approved by the regulators, of course, just to keep the income statement looking healthy while the physical asset is being built in the real world.
That is a highly accurate way to frame it, yeah. A bridge loan to themselves.
Okay, so when Exelon says they got a 4-cent bump from rates net of AFUDC, they're saying what exactly?
They are saying that new, completed, used, and useful assets finally went online, began earning that real guaranteed cash return, and that real cash return outweighed the PPR accounting adjustments of their other ongoing construction projects.
Ah, that makes total sense. It shows the pipeline of physical projects is actually successfully converting into actual cash-generating assets.
Exactly, real cash.
Perfect. So what were the other tailwinds that added to that gross gain?
Well, they saw another 4-cent per share benefit simply due to the absence of a customer relief fund that was on the books during the second quarter of last year.
Okay, so that is really just a year-over-year accounting quirk.
Basically.
Last year, they had a special expense to help ratepayers. This year, that expense is gone, so earnings just mechanically look 4 cents better.
Correct. It is just a one-time structural comparison benefit.
Got it. And the final piece.
The final positive contributor was a penny. Literally 1 cent per share, derived from favorable weather conditions, specifically in the territory served by PECO, which is their utility operating in Pennsylvania.
Okay, let's dig into that penny for a second, because weather normalization is a really crucial concept for this sector.
It really is.
Utilities have software models that predict exactly how much power people will use on an average, say, 75-degree day.
Right.
And when the weather gets hotter than that historical average, air conditioners work a lot harder, power usage goes up, and the utility makes extra money.
That's the mechanism, yeah.
So PECO had slightly hotter weather than the models predicted, resulting in an extra penny of earnings. But that brings us to 9 cents of positive momentum. The net gain was only 4 cents. So where did the spreadsheet bleed?
Right, so the gross gains were dragged down by two primary headwinds. First, they absorbed a 2 cent per share hit from higher credit loss expenses.
Ouch.
Yeah. And that was primarily located at BGE, which is their utility covering Central Maryland, including Baltimore.
Okay, let's translate that. A credit loss expense is just a very sterile corporate way of saying that everyday customers are failing to pay their utility bills, right?
It's bad debt.
But why is this happening specifically in BGE territory right now? I mean, if employment is relatively stable in the broader macro environment, what is driving a sudden spike in bad debt for a utility?
That's a great question.
Is this a localized Maryland economic issue? Or is it a lag effect from something else?
It's definitely less about a localized Maryland recession and much more about the delayed mechanical unwinding of pandemic-era policies colliding with cumulative inflation.
Okay, explain that.
So during and immediately following the pandemic, many state utility commissions, Maryland's included, they instituted these strict moratoriums preventing utilities from shutting off power to delinquent accounts.
Right, you couldn't get your power cut even if you didn't pay.
Right. They forced the utilities to keep the power flowing regardless. Well, those moratoriums have largely ended now.
Okay. The bill comes due.
Exactly. Now, utilities are finally reconciling years of accumulated unpaid balances. And when you combine that resumption of normal collection practices with the reality that cumulative inflation over the last 3 years has severely strained the budgets of lower income and middle income ratepayers.
You see a sharp spike in uncollectible accounts.
Precisely. The utility eventually just has to write those off, which hits the bottom line directly as a credit loss expense.
That implies a major structural lag in the economy then.
Oh, absolutely.
Because the macroeconomic data might show inflation cooling off right now. Headline inflation is down, but the household balance sheet is still deeply damaged from the price spikes of 2023 and 2024.
Yep.
And it is finally showing up in utility earnings in mid-2026.
It is a textbook delayed indicator.
So that's the 2-cent loss. What was the other headwind?
The final headwind that brought the net number down to that final 4-cent increase was a 2-cent per share drag from higher interest expenses.
Also makes sense.
Yeah, that was located both at the corporate holding company level and down at the PICO utility level.
Which is completely logical given the macroeconomic environment. I mean, utilities are incredibly capital-intensive businesses.
Massive amounts of debt, yeah.
They are effectively giant bond proxies. So when the broader cost of debt rises across the economy, their borrowing costs inherently go up, eating into their margins.
It's unavoidable.
But when you look at this entire mathematical bridge, 9 cents of gains from basic rate base growth and weather, minus 5 cents of losses from customer bad debt and macro interest rates, it is a remarkably predictable picture.
That's the beauty of it.
Right. This isn't a company relying on a sudden viral product launch or a massive market share acquisition. It is a company operating a giant machine, turning the crank and extracting exactly what the spreadsheet predicted.
And for a conservative portfolio, that predictability is the entire value proposition. I mean, the goal of investing in a regulated utility is to eliminate volatility.
Oh, boring.
You want boring. You are seeking a reliable dividend yield and the slow compounding growth of the underlying asset base.
Right.
So when a management team delivers a quarter that hits the consensus expectation exactly, and they can mathematically explain the origin of every single penny of variance from the previous year, it broadcasts a powerful signal to the institutional market.
What's the signal?
It says that management has absolute visibility into their own operations. They're not being surprised by their own business, which strongly implies that you, as the shareholder, are not going to wake up to a sudden catastrophic earnings miss next quarter.
I view it through the lens of engineering. You don't want a shock absorber on your car to occasionally perform a spectacular, unexpected leap.
No. Definitely not.
You want it to compress and expand exactly the same way every single time, regardless of how rocky the road gets.
That's a great analogy.
And that is the perfect transition to the physical reality of what Exelon faced this quarter. Because the financial spreadsheet looks calm, methodical, perfectly engineered. But the physical environment where those numbers were actually generated was incredibly violent.
Brutal, yeah.
What actually happened out in the field?
This is arguably the most critical operational data point from the entire earnings presentation. The physical infrastructure of the grid, specifically within Exelon's operating territories, was subjected to a level of sustained, severe weather stress that literally breaks historical models.
Break it down for us.
Let's isolate ComEd, their utility that serves Chicago and the broader northern Illinois region. In just the first half of 2026, ComEd experienced 16 major weather events. 16. To put that in context, that is the highest frequency of severe weather events they have recorded in more than 20 years. Furthermore, the state of Illinois has officially recorded more tornadoes this year than any other state in the entire country.
Okay, I want you listening to really internalize that statistic. More tornadoes in Illinois than anywhere else. Historically, we associate that kind of concentrated destructive weather with Tornado Alley in the Great Plains, right?
Oklahoma, Kansas, Texas.
Exactly. The fact that the epicenter of tornadic activity has shifted into the heavily populated, infrastructure-dense Midwest is a massive variable change for a utility operating there.
It changes everything.
You aren't just dealing with high wind, you are dealing with catastrophic, localized destruction of physical assets.
And that destruction materialized heavily during this quarter. Management highlighted a specific severe storm system that rolled through the territory on a Monday. The damage was so extensive that it knocked out power to approximately 530,000 customers simultaneously.
500,000 accounts in the dark.
Yeah.
Which implies, what, well over 1 million actual human beings without power?
At least.
From an operational standpoint, a mass outage event of that scale is a logistical nightmare.
It's chaos.
It isn't just about flipping a switch back on at a substation. You have physical trees lying across physical wires, transformers that have blown and need to be replaced, poles that have snapped in half. How does a utility actually coordinate a response to a disaster that large?
Well, it requires a militaristic level of logistics and the activation of mutual assistance networks.
Mutual assistance?
Yeah, when an outage hits that scale, a single utility's local workforce is instantly overwhelmed. They have to invoke agreements with other utility companies across different states to physically drive fleets of bucket trucks and linemen into the disaster zone to help.
Wow, just convoys of trucks.
Exactly. But the metric that retail investors need to focus on isn't the scale of the damage, it is the velocity of the recovery.
Okay.
Because despite the severity of that storm and the sheer volume of those 530,000 outages, Exelon's crews successfully restored power to 90% of those affected customers within 48 hours.
Getting 90% of a 500,000 customer outage restored in 2 days is a phenomenal logistical achievement.
It really is.
But I want to tie this back to our talk tickers focus here.
Yeah.
The bottom line. It is easy to view rapid storm restoration as a public relations win, a way to keep the regulators and the politicians off the company's back.
Sure.
But there is a direct, quantifiable financial value to that level of operational resilience, isn't there?
Absolutely. It is an economic shield for the entire region. The CEO, Calvin Butler, provided a fascinating data point on the call to illustrate this.
What was it?
He stated that in the previous year, 2025, Exelon's ability to maintain top quartile reliability, essentially keeping the grid functioning when lesser systems would have failed, saved their customers an estimated $1 billion in avoided outage costs.
Avoided outage costs. That is such a brilliant metric. We often only measure the cost of electricity by the rate on the monthly bill, right?
Yeah, the visible cost.
But the true cost of electricity is what happens to a business when the power isn't there. If a manufacturing plant loses power for 6 hours, the assembly line stops, the workers are standing around being paid to do nothing, the production quota is missed.
Massive losses.
If a grocery store loses power for 2 days, hundreds of thousands of dollars of refrigerated inventory spoils and has to be literally thrown away.
Gone.
So when Exelon spends capital to harden the grid, they aren't just protecting their own revenue stream, they are subsidizing the economic output of the entire state.
And the data proves the hardening is working.
Yeah.
Management actually noted that annual customer interruptions across their system have declined by nearly 2 million incidents since 2021.
That's a huge drop.
Yeah, the physical grid is objectively becoming more durable.
Right.
But, the severe thunderstorms were only one half of the physical stress test.
Right.
The other half was the heat. We really need to analyze what happened in July because this specific event exposed the underlying fragility of the entire national energy landscape.
Right, the July heat wave. Because this is where the story shifts from localized weather damage to systemic market failure. Walk us through what happened to the PJM grid when the temperatures spiked.
Okay, for context, the PJM interconnection is a massive regional transmission organization.
The central nervous system of the grid.
Exactly. It coordinates the generation and movement of wholesale electricity across 13 states and the District of Columbia. It is the largest wholesale electricity market in the United States.
Massive footprint.
And during the peak of the heat wave in early July, the demand on the PJM grid surged to a staggering record peak of 168 gigawatts.
Okay, let's give that number some tangible scale for you listening. 1 gigawatt is roughly the amount of power required to run 750,000 average homes.
Right.
So 168 gigawatts means the system was trying to simultaneously deliver enough electricity to power the equivalent of 126 million homes.
It's an incomprehensible volume of energy.
Just being pulled through the wires at the exact same millisecond.
And the pull was so intense that the grid operators at PJM actually ran out of standard generation reserves.
Wait, they ran out?
Yes. They actually had to activate formal emergency procedures. They had to call upon demand response resources, which involves paying large industrial users to physically shut down their factories just to maintain the frequency of the grid and prevent rolling blackouts.
They had to pay factories to stop working so the grid wouldn't crash.
Exactly. But the truly alarming metric is what this scarcity did to the wholesale pricing mechanism. Because the system was operating so perilously close to the edge of failure, the fundamental laws of supply and demand took over violently.
Okay, give us the numbers.
The price of power in the wholesale market surged from a normal, comfortable baseline of roughly $80 per megawatt hour to an astounding $800 per megawatt hour.
I really want to push on this because it exposes a major flaw in how retail investors perceive utilities.
Go for it.
Most people think electricity is a static product with a fixed cost. You know, you pay your 10 cents a kilowatt hour and that's it.
All right, that's what's on the bill.
But in the wholesale market, electricity is a highly volatile commodity. It has to be produced and consumed instantly. So when you have a tenfold price spike from $80 to $800 happening in real time just because the temperature went up a few degrees, it suggests that the market has absolutely zero shock absorbers left. If the system was healthy, a demand spike would just trigger backup power plants to turn on, and the price would stay relatively flat.
Exactly.
The fact that the price exploded means those backup plants simply don't exist anymore.
Your intuition is entirely correct. This is not a temporary anomaly caused by a hot week in July. It is a symptom of a deeply rooted systemic disease in the American power markets.
A structural scarcity.
That disease is a fundamental structural scarcity of supply. And we do not have to guess about this scarcity. We have undeniable mathematical proof of it in the results of PJM's most recent capacity auction.
Okay. We are entering the deep end of energy market mechanics here. And this is crucial for anyone trying to invest in this space. We need to clearly differentiate the markets.
Yeah, this is important.
When I turn on my lights, I am buying power from the energy market, paying for the actual electrons flowing into my house right now.
Correct.
But a capacity auction is a totally different financial instrument. Explain how the capacity market functions and why this recent auction has terrified grid operators.
It is the most important distinction in energy economics. You have the energy market, which pays for the megawatt hours you consume today, but you also have the capacity market, which pays for the promise of capability tomorrow.
The promise of capability?
Yeah. A capacity auction is essentially an insurance policy for the grid. PJM looks 3 years into the future and runs a calculation. They say, based on economic growth and weather trends, we predict we will need an absolute maximum of X amount of power on the single hottest, worst day of the year in 2029. PJM then holds an auction, offering to pay power plant owners a flat daily fee just to guarantee that their plant will be available to turn on during that theoretical worst-case scenario.
So it's a retainer fee?
Yes. You are paying for the physical capability to exist, regardless of whether you actually ask them to generate power on that day.
Okay, it is exactly like paying an insurance premium. You pay your auto insurance every month, not because you plan on crashing your car today, but to guarantee the financial protection is there if you crash it next year.
Right.
The capacity market is paying power plants to exist so the grid doesn't crash during a heat wave.
Precisely. And the unit of measurement in this market is the megawatt day. It is the price paid to reserve 1 megawatt of capacity for a 24-hour period.
Got it.
So PJM ran this auction to secure the insurance policy for the future grid. And the results were catastrophic.
What happened?
For the third consecutive auction, the clearing prices hit the absolute maximum price cap legally permitted by the Federal Energy Regulatory Commission, or FERC.
Wait, they hit the cap?
They hit the cap, but even at the maximum legal price, the market failed to attract enough willing supply. The auction closed with a massive shortfall, coming in 6.8 gigawatts below PJM's calculated reliability requirement.
Wait, let me make sure I'm understanding the mechanics of this failure. The market operator walked into the room, offered the absolute highest amount of money they are legally allowed to offer to anyone who could guarantee power in the future, and nobody took the deal.
That is exactly what happened.
The power plants simply do not exist to answer the call, even at maximum price.
No, they don't. And to visualize the scale of a 6.8 gigawatt hole in the grid, you have to imagine the output of roughly 7 massive full-scale nuclear reactors just completely vanishing from the system.
7 nuclear reactors, that's insane.
And the trajectory is worsening. In the previous auction, the shortfall was 6.5 gigawatts. The gap between what society needs and what the physical infrastructure can provide is widening every single year.
This brings up a massive philosophical and economic question about market design. Why do we even have price caps in a capacity market?
That is the big debate right now.
I mean, if you put an artificial ceiling on the price, aren't you just breaking the primary signaling mechanism of capitalism?
Inherently, yes.
If the grid is starving for power, the price should theoretically rise to infinity until it becomes so profitable to build a new power plant that capital floods into the sector to build it. By capping the price, FERC is effectively blinding the market to the true severity of the shortage.
That is exactly the argument happening in regulatory circles. The argument for price caps is that they protect consumers from predatory pricing and market manipulation by dominant generation companies.
Sure, but if the lights go out?
Right. Your point is the core of the current crisis. If the cap is set too low, it fails to incentivize the multi-billion-dollar capital investments required to build new, reliable baseload generation, like natural gas or nuclear plants.
Right, nobody built it.
And management provided a terrifying data point on the call that proves your theory. PJM actually ran a parallel simulation to determine what the true natural market price would have been if FERC had not mandated that artificial ceiling.
Oh, wow. What were the simulated numbers? Like, how deep is the delusion here?
Okay, so the official FERC approved price cap that the auction cleared at was $330 per megawatt day. But PJM's simulation revealed that without the cap, the true market price would have surged to $555 per megawatt day across the general footprint.
That's a massive jump.
And it gets worse in localized, highly congested areas. In the ComEd region specifically, the true uncapped price required to balance supply and demand would have been an astonishing $777 per megawatt day.
That is a staggering spread. The official paperwork says the value of grid insurance is $330, but the underlying physics of the grid are screaming that the true value is $777.
It's totally disconnected from reality.
The regulators are suppressing the price signal by more than 100%, which means the scarcity is infinitely more severe than the official headline numbers suggest.
Without a doubt.
We have a situation where demand is accelerating, older coal and gas plants are retiring because they can't make a profit under these artificial caps, and the entire system is quietly starving to death.
That's exactly what's happening.
But as retail investors evaluating Exelon, we cannot just sit here and admire the problem.
No, we have to find the play.
Right. We are not paying management to complain about broken market design. We are paying them to allocate capital to solve the problem and generate a return on that capital. So how is Exelon pivoting to exploit this massive gap in supply?
They are actively recognizing that the deregulated wholesale market is failing to provide adequate generation. So they're stepping into the void by heavily advocating for and building utility-owned generation and storage solutions.
Give me an example.
The most prominent example they detailed on the call is a massive new battery energy storage system they are developing in New Jersey through their subsidiary Atlantic City Electric.
Ah, the Pittsgrove project.
Yes, Pittsgrove.
Let's look at the engineering specs on this facility because it highlights a major shift in how utilities are deploying capital. We are talking about a 500 megawatt battery installation utilizing 4-hour duration lithium-ion technology.
It's huge.
When this facility is fully charged and deployed, it will be capable of powering approximately 400,000 homes simultaneously for that 4-hour window.
And when it comes online, it will stand as the single largest battery storage installation in the entire PJM territory. It represents a capital investment of approximately $1 billion.
$1 billion.
Okay, but what makes this so attractive for an EXC shareholder is that this $1 billion is not currently modeled into their existing base capital plan. It represents pure incremental upside growth for the rate base.
Okay, but I want to play devil's advocate here on the regulatory side.
Sure.
How does a utility actually convince a state public utility commission to allow them to rate base a $1 billion battery? Regulators are notoriously stingy, right?
Yeah.
Their primary job is to keep customer bills as low as possible.
That's the tension, yeah.
And a billion-dollar lithium-ion battery has inherent risks. It degrades over time much faster than a steel transmission tower. In 10 or 15 years, the capacity of those cells will drop. So why would a regulator force ratepayers to fit the bill for an asset with a relatively short lifespan compared to traditional grid infrastructure?
That is the exact hurdle they have to clear. And the way they clear it is by proving the overwhelming economic utility of the asset during crisis events. The justification isn't about the lifespan of the physical battery cells. It is about the financial devastation the battery prevents while it is operational.
Right.
Management provided a highly specific simulated use case based on the July heat wave to prove this point to the regulators and the investors.
Okay, walk us through the simulation. How does the battery actually pay for itself?
So they calculated that if the Pittsgrove battery had been fully operational during the severe heat stress from July 2nd through July 5th, it would have saved the ratepayers of Atlantic City Electric approximately $7.5 million in wholesale energy costs over just that 4-day window.
$7.5 million in 96 hours.
Incredible, right?
How does the mechanism of those savings actually work, like step by step?
Okay, it is the ultimate arbitrage machine designed for grid stability rather than private profit. So, the battery charges itself in the middle of the night, say at 3 a.m., when demand is exceptionally low and wholesale power is cheap and abundant. Maybe $30 a megawatt hour.
Okay, it fills up on cheap power.
Right. It stores that cheap energy. Then during the peak of the heat wave at 5:00 p.m., when the grid is redlining and the wholesale price violently spikes to that $800 per megawatt hour mark we talked about, the battery discharges its stored energy directly into the local grid.
So instead of the utility being forced to buy power from the open market at the agonizing $800 price point and eventually passing that cost on to the consumer, they just release the $30 power they stored the night before.
Exactly.
They're essentially shaving the absolute most expensive peak off the demand curve.
Precisely. It acts as a massive financial shock absorber. Over a long enough timeline, an asset that can dynamically neutralize extreme peak pricing events becomes incredibly valuable.
The math just makes sense.
Yeah. Exelon estimates that over the lifespan of the project, customers will realize over $700 million in net economic benefits. Furthermore, to get the regulators on board, they structured the financing brilliantly. They stated there will be zero impact on customer monthly bills until at least the year 2035.
Wait, how is that mathematically possible? How do you spend $1 billion today without raising rates tomorrow?
They are bridging the gap by utilizing anticipated revenues from bidding the battery into the PJM frequency regulation markets.
Sure.
They're also harvesting massive federal tax credits available under recent legislation.
Ah, the federal subsidies.
Yes. And they're offsetting the cost against deferred traditional transmission investments they no longer have to make because the battery actually solves the local congestion issues.
It is a highly sophisticated capital deployment strategy. And they aren't just relying on massive utility-scale batteries to solve the problem, are they? They are also pushing into decentralized solutions.
Correct. They noted significant regulatory momentum across their footprint for virtual power plant, or VPP, programs. Several of their operating utilities recently received formal approval to expand these initiatives.
For the uninitiated retail investor, the concept of a virtual power plant sounds like science fiction, but the reality of it is just fascinating.
It really is.
Instead of pouring concrete and building one giant centralized power plant, a utility uses software to network together thousands of small customer-owned devices.
Right, they just aggregate it.
Yeah, they connect to residential home batteries, smart thermostats, rooftop solar inverters, and during a peak demand event, the utility software can orchestrate all of those devices simultaneously, like telling 50,000 smart thermostats to raise the AC temperature by 2 degrees for 30 minutes. And the aggregated reduction in demand functions exactly the same as turning on a 50-megawatt power plant. It fundamentally changes the relationship with the customer.
It absolutely does. It turns the ratepayer from a passive consumer into an active, dispatchable grid asset.
Which is brilliant.
It immediately reduces peak system pressure. It requires zero new concrete, and the customers receive direct financial compensation for allowing the utility to manage their devices.
Win-win.
Yeah, it's a practical, highly capital-efficient solution that Exelon can deploy rapidly while waiting for the larger physical infrastructure to be built.
Okay, we have established a very clear picture of the present reality. The grid is under immense physical stress, the wholesale markets are fundamentally broken and short on supply, and Exelon is successfully deploying capital into localized resilience like batteries and VPPs to navigate this chaos.
That's the landscape today, yes.
But investing is inherently forward-looking. The stock price today is a reflection of cash flows tomorrow. We need to pivot from the current environment and examine management's guidance for the future.
This is where it gets interesting.
And that means we have to address the absolute massive elephant in the room regarding future electricity demand. Artificial intelligence data centers.
Always. The AI boom.
Every retail investor, whether they are analyzing NVIDIA or a boring utility, is obsessed with the AI demand narrative right now. Let's look at the baseline financial guidance first, and then tackle the AI pipeline. What are the macro growth expectations?
Well, looking at the immediate term, management shaped the expectations for the third quarter of 2026, guiding that earnings should represent roughly 27% of the midpoint of their full-year range.
Okay, pretty standard.
Yeah, this quarterly shaping is standard. It accounts for historical third-quarter weather patterns, anticipated storm response costs, and a slight drag from a BGE employee strike that occurred early in the quarter.
But what about the long term?
The macro long-term guidance is where the value lies. They confidently reaffirm their commitment to delivering a 5% to 7% annualized earnings growth rate from 2025 all the way through 2029.
Okay, to guarantee 5 to 7% compounded annual growth for a utility of this size requires a gargantuan amount of capital expenditure. You can't grow earnings without growing the rate base, and you can't grow the rate base without putting shovels in the ground. What is the scale of their spending plan?
It is massive. They are actively on track to deploy $10 billion in capital expenditures in the year 2026 alone.
$10 billion in 1 year.
Yes. And looking across the planning horizon to 2029, their total capital deployment will reach $41 billion.
Wow.
That scale of investment supports a projected 7.9% annualized growth rate in their underlying rate base.
$41 billion over the next few years flowing into wires, transformers, and substations. But here is the critical vulnerability in that plan. The justification to regulators for spending $41 billion is heavily dependent on proving that future load growth like future demand for electricity actually requires it.
Obviously, yeah. If demand stagnates, they can't spend it.
Right. Regulators will reject the spending to protect ratepayers. And right now, the entire justification for explosive load growth is tied to the construction of AI data centers. Which brings us to the most scrutinized, debated slide in their entire earnings presentation, the data center pipeline update. What did management reveal?
This is the crux of the analysis. During the call, management provided a formal update on the scale of their projected data center demand pipeline. Previously, they had touted a massive pipeline of 43 gigawatts of potential new demand.
Which is huge.
Right. But in this Q2 update, they revised that number downward, stating the pipeline now stands at a combined 36 gigawatts across their entire footprint.
Okay, I'm going to stop you right there, and I want to offer some very real, aggressive pushback on this point, because this is where you, as a retail investor, need to be highly skeptical.
I know where you're going with that.
A reduction from 43 gigawatts down to 36 gigawatts is a loss of 7 gigawatts of potential demand. 7 gigawatts is the equivalent of 7 nuclear power plants worth of customer demand that just vanished from their projections.
It looks bad on paper.
We are in the middle of a global AI arms race. Tech companies are desperate for power. If the market for electricity is booming, why on earth is Exelon's pipeline shrinking? Are they actively choking off their own growth?
No, but
I mean, are they forcing Microsoft and Google to abandon Illinois and take their billion-dollar data centers to unregulated markets like Texas or to competing utilities? Why did management spend the Q&A session framing this massive reduction in potential business as a strategic victory?
It is a completely valid challenge. And to understand why management is framing it as a victory, you have to look past the headline number and understand the chaotic reality of the utility interconnection queue right now.
Okay, explain it to me.
You were right. It is an arms race. But because it is an arms race, the system is being flooded with phantom projects.
Phantom projects.
Yes. Every real estate developer who owns a vacant lot near a fiber optic cable is submitting an application to the utility claiming they are going to build a gigawatt-scale AI data center.
Wait, really? Just anyone with land?
Anyone. They submit these applications just to secure a spot in line, hoping to flip the land and the grid connection to a major tech company later.
Oh, wow. They're squatting on the grid.
Exactly. The utility queues are hopelessly clogged with highly speculative, entirely unfunded fantasy projects that will never actually be built.
Okay, I see where this is going. If the utility takes those fantasy projects seriously, they have to spend millions of dollars running complex engineering studies to figure out how to connect them.
Yes.
And worse, they might start ordering massive, expensive electrical equipment like custom transformers that have a 3-year lead time to prepare for demand that ultimately never materializes.
Exactly. And if the developer walks away, the utility is left holding the bag on millions of dollars of useless equipment. And the regulators force the existing residential ratepayers to absorb that cost.
Which is an unacceptable financial risk.
Totally unacceptable. So to protect the balance sheet and the ratepayers, Exelon changed the rules of engagement. They implemented a new, highly stringent contractual mechanism called Transmission Security Agreements, or TSAs.
TSAs.
Okay, they went to the developers in the queue and effectively said, we will process your application, but before we order a single piece of equipment or reserve capacity on our grid, you must sign a TSA and provide us with massive, hard financial collateral.
Let's reframe the analogy here. This isn't just a bouncer at a nightclub checking IDs. This is like an underwriter at a major insurance company staring down a client who wants a massive, high-risk policy.
Like they need proof.
The underwriter isn't going to just take the client's word that they have a safe bet. They demand an exorbitant upfront premium to mathematically guarantee that the insurance company won't take a loss if the client defaults. Exelon is forcing these developers to put their own balance sheets on the line before the utility assumes any operational risk.
That is the exact dynamic. And the immediate result of instituting that strict underwriting policy was the evaporation of the phantom projects.
The window shoppers left.
Exactly. The pipeline revision from 43 gigawatts down to 36 wasn't a loss of real business to competitors in Texas. It was the forceful, intentional weeding out of the speculative developers who couldn't secure financing. Exelon actively scrubbed the noise out of their own projections.
They flushed the system of the window shoppers. Okay, so if we look at the remaining 36 gigawatts that survived the purge, how much of that is actually tangible, actionable demand that an investor can model into a valuation?
Management provided a very clear stratification of the remaining pipeline. Of the 36 gigawatts, they have identified 11 gigawatts as high probability.
Okay, 11 gigawatts.
Within that 11 gigawatt bucket, roughly 7 gigawatts represent legacy projects that predated the new TSA rules, but are already so far along in the physical development and construction phase that Exelon is highly confident they will reach completion.
They're already pouring concrete.
Right. But the true proof of concept for their strategy lies in the remaining 4 gigawatts.
What is the status of those 4 gigawatts?
They have 4 gigawatts of new data center demand that has successfully run the gauntlet, formally signed the transmission security agreements, and crucially, those specific agreements are currently backed by an astonishing $1 billion in hard financial collateral provided by the developers.
Let's run the math on that because it is staggering. $1 billion in collateral for just 4 gigawatts of demand means the developers are putting up $250 million per gigawatt just for the privilege of securing a grid connection.
It's massive.
That tells you two things. First, the tech companies are so desperate for reliable power that they are willing to lock up massive amounts of capital just to guarantee their place in line.
Right.
Second, it proves that Exelon has completely insulated its existing ratepayers. If a tech giant suddenly pivots its strategy in 2 years and abandons a partially built data center, Exelon keeps the collateral, uses it to pay off any equipment they already ordered, and the residential customer in Chicago or Baltimore doesn't see their monthly bill increase by a single cent.
It is the ultimate risk mitigation strategy. It allows them to capture the unprecedented upside of the AI boom without exposing their balance sheet to the inherent volatility of the tech sector.
It's brilliant.
Furthermore, management explicitly noted that their $41 billion capital plan through 2029 remains completely unchanged despite the pipeline shrinking by 7 gigawatts.
Wait, how is that possible? If the demand projection shrinks, shouldn't the capital expenditure required to service that demand also shrink?
It would, if they had been foolish enough to include speculative projects in their financial models in the first place.
Yeah.
But management demonstrated extreme discipline. They only ever mapped capital deployment against highly certain durable growth. They never modeled the fantasy projects, so removing them has zero impact on the actual financial guidance. They still have 25 gigawatts of demand remaining in the pipeline to study and process, but they have now established a rigorous, impenetrable financial filter to determine which projects actually get built.
This fundamentally alters the narrative surrounding the stock for a retail investor. You know, the financial media loves to hype up the massive, unverified numbers of the AI infrastructure boom.
Oh, it's all they talk about.
But when you are analyzing a regulated utility, risk mitigation is just as important, if not more important, than theoretical growth.
Absolutely.
Which brings us perfectly to the final critical segment of our deep dive today. We have meticulously unpacked the baseline earnings beat and the regulatory accounting. We have deeply explored the physical chaos on the grid and the terrifying shortfall in the capacity markets. And we have decoded the underlying strategy behind the data center pipeline reduction.
We've covered a lot of ground.
We have. It is time to answer the ultimate talk tickers question. We need to synthesize the data, weigh the macroeconomic risks, and deliver a definitive, opinionated verdict on the stock.
It is time for the bottom line.
When you aggregate the totality of the Q2 2026 earnings data, the management strategy, and the physical reality of the grid, where do you land on Exelon? Is this stock a buy, a hold, or a sell?
Taking a definitive stance based on the empirical evidence we have reviewed today, I am decidedly bullish on Exelon.
Bullish, okay.
Specifically for the conservative, income-focused retail investor who prioritizes capital preservation, predictable dividend yields, and defense against macroeconomic volatility.
I want you to vigorously defend that bullish thesis. Because the grid is literally falling short of supply, storms are intensifying, and interest rates remain a persistent macro threat. Why is EXC the specific vehicle you want to hold to navigate this environment?
Because Exelon is structurally proving, with hard mathematical data, that it can successfully neutralize the two most existential threats facing the modern utility sector.
Let's categorize them. Threat number one is the physical degradation of the operating environment.
Yes. Threat number one is extreme weather volatility and the sheer physical strain on the infrastructure. We reviewed the numbers. 16 major weather events for ComEd alone. Illinois leading the nation in tornadoes.
500,000 people in the dark.
500,000 people plunging into darkness during a single storm. And the PJM grid redlining at 168 gigawatts during a heat wave. The environment is openly hostile.
It is.
But Exelon's response proved their operational superiority. They achieved top quartile reliability metrics. They executed a logistical masterclass by restoring 90% of a massive outage within 48 hours. By maintaining the integrity of the grid, they protected their state economies from $1 billion in avoided outage costs.
The proof is in the execution.
Exactly. This proves that their $41 billion capital plan isn't just theoretical. It is actively yielding a hardened, resilient physical asset base that can withstand the chaos.
I agree completely. When the physical world becomes unpredictable, the premium on operational competence skyrockets. You want to own the management team that knows exactly how to deploy a mutual assistance fleet and optimize a billion-dollar battery to shave peak pricing. What is the second existential threat they are neutralizing?
Threat number two is the financial risk of uncontrolled speculative load growth.
The tech bro pipe dreams.
Right. The AI data center boom is the greatest demand shock in the history of the grid. It is a massive opportunity, but if a utility manages it poorly, if they overbuild infrastructure for tech companies that eventually default or abandon projects, it could lead to absolute financial ruin for the utility and its ratepayers.
The threat of the phantom pipeline bankrupting the legacy utility.
Exactly. But we just analyzed how Exelon entirely neutralized that threat. By instituting the transmission security agreements and demanding $1 billion in hard financial collateral upfront, they proved they will aggressively defend their balance sheet.
They act as the underwriter.
Yes. They are forcing the tech sector to subsidize the risk of its own expansion. They successfully converted a chaotic, highly speculative demand boom into a structured, mathematically secure pipeline of growth.
They filter out the risk while systematically capturing the upside. But a bullish thesis on a utility is incomplete without stress testing the foundation of the company itself, the balance sheet. If you are going to hold this stock through potential economic turbulence, you need absolute certainty that they can actually fund their operations without diluting shareholders into oblivion. What did the CFO reveal about their current financing position?
This is the data point that should allow a retail investor to sleep soundly at night. The CFO detailed that they are executing their massive financing plan with extreme proactive discipline.
How so?
As of this Q2 earnings call in early August, Exelon has already successfully completed approximately 86% of their total debt financing requirements for the entire year of 2026.
86% done.
Done. This includes securing all expected debt issuances at their major utility holding companies.
Let's unpack the strategic value of that. By locking in 86% of their required debt financing before the end of the summer, they have almost entirely insulated themselves from interest rate volatility for the remainder of the year.
Completely insulated.
If the Federal Reserve suddenly pivots, or if bond yields violently spike tomorrow due to a macroeconomic shock, Exelon is largely immune because their borrowing is already finalized and the cash is secured.
Exactly. They removed the macro risk from their immediate operational timeline, but their strategy on the equity side is even more impressive.
What are they doing on equity?
To help fund their $41 billion capital plan, they are utilizing a highly specific forward contract structure under their at-the-market, or ATM, equity program.
Okay.
Through this advanced financial mechanism, they have already priced and secured approximately 37% of their planned equity needs all the way through the year 2029.
The mechanics of an ATM forward contract are incredibly powerful. It allows a company to agree to sell shares at today's stock price, but they don't actually have to issue the shares or take the cash until a future date when they actually need the money.
Right. They just lock it in.
It is the ultimate hedging tool.
It is. And to translate that 37% figure into actionable near-term context, it means they have successfully locked in the price for 100% of their equity needs for the entirety of 2026 and 50% of their equity needs for 2027.
Wow.
They have built an impenetrable moat around their funding plan, completely decoupling their ability to build infrastructure from the near-term manic volatility of the stock market.
If you are holding EXE in your portfolio, you are holding a definitive fortress stock. Think about the layers of defense management has constructed.
Layer upon layer.
They built a physical moat around their operations through aggressive grid hardening and rapid storm response. They built a contractual moat around their growth pipeline by enforcing TSAs and demanding billion-dollar collateral from the tech giants. And they built a financial moat around their balance sheet by pre-funding their debt and locking in their equity prices years in advance. For the retail investor, the actionable takeaway from this deep dive is clear. Ignore the superficial, panicked headlines about their data center pipeline shrinking from 43 to 36 gigawatts. Because, as we discovered today, by intentionally shrinking the volume, the actual structural quality of that pipeline just went through the roof.
It is the absolute definition of addition by subtraction. They systematically eradicated the risk while retaining the core revenue potential.
That is a phenomenal synthesis of the quarter. We have torn apart the baseline earnings. We have analyzed the physical breakdown of the wholesale capacity markets. We have evaluated the TSA underwriting strategy for data centers, and we have verified the Fortress balance sheet. But before we conclude this Talk Tickers deep dive, we always adhere to one final rule.
The final thought.
Right. We want to leave you, our listeners, with a provocative, forward-looking macroeconomic thought. Something that builds logically on the data we analyzed today, but points to a horizon the broader market might be missing.
Yeah, and when you aggregate the raw data from this specific earnings call, there is a chilling macro dynamic crystallizing that every single investor, regardless of whether they trade utilities, tech, or broad index funds, desperately needs to be monitoring.
This raises an important question.
Exactly. I want you to think back to the PJM capacity option failure we discussed earlier. The central nervous system of the American grid is currently operating with a massive 6.8 gigawatt shortfall.
The 7 missing nuclear reactors.
Right. The physical reality is that we are missing that power. We know from the simulation data that the true uncapped market price of power during a stress event was secretly surging to an unsustainable $777 per megawatt day.
The system is structurally starving, and the regulators are throwing a blanket over the price signal to hide the panic.
Now, consider the timeline. That massive physical shortfall and that terrifying suppressed price surge is happening right now, today, in 2026.
Today.
It is happening before the vast majority of these 11 gigawatts of high probability collateral-backed AI data centers even finish construction, come online, and plug their massive demand into the grid.
Oh, wow. The foundation of the house is already visibly cracking and failing before they have even started moving the heavy furniture in.
Yes. So the fundamental question you have to mull over as an investor is this. How long can these artificial FERC price caps actually hold before the sheer undeniable physics of energy demand force a massive systemic repricing of electricity across the entire American economy.
Wow.
If the true underlying price of grid insurance is $777 today, what is it going to be when those massive data centers simultaneously flip the switch in 2028? The entire paradigm of cheap, infinitely abundant American power might be quietly coming to an end.
It really might.
And in that new capacity-constrained world, the utility companies that physically control the generation assets and enforce strict financial discipline to protect their balance sheets, exactly like Exelon is doing right now, are going to transition from boring dividend stocks into the most critical gatekeepers of the new economy.
That is a staggering macroeconomic thought to end on. The idea that the sheer physics of energy demand will eventually break the artificial financial caps, forcing a total repricing of how we value power. If you enjoyed this level of uncompromising analysis, remember the talk ticker's mandate. Stay data forward, ignore the mainstream noise, actively look for the fortress balance sheets in your portfolio, and keep your investments resilient against the chaos. Thank you for joining us for this deep dive.